Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a quick look at Walmart, ticker WMT. I had a friend ask me to look into this one. I knew already it didn't really meet my criteria. They're known for their low margin, high volume, and I just don't like low margin companies. But there's other things here too. I mean, of course, with the low margin, you're going to have low cash flows, and they might have really high revenues, but it doesn't make it down to the bottom line whatsoever. So what we're looking at here, currently trading for $94. It's been as high as 96, been as low as 50 in the last 52 weeks. Coming up with a fair value, 53.5, discounted cash flows. Let's round it up to 66. So down at 52-week low might have been a decent time to get in if it was a stock that you were interested in. Right now, definitely is not. We're getting an earnings yield of 3.76%. So we'd want them to come in with an EPS of $4.71 per share. And when we go look at the metrics, what we're looking at is this year analyst expectations of 248, next year 275. And you can look historically 192, 143, 163. They don't have massive earnings per share. You do have them buying back shares, which will help over time get that earnings per share number up. I mean, that's a 1 to 2% bump right there. But clearly, they're overvalued. Their current PE ratio is 38. Historically, at least our 5-year time frame here, they've averaged 28. And as you can see, 38 is the highest in this time frame. So unless you expect them to come out with something new to generate more revenue or to them acquire something, one of their competitors, I don't know why it's trading at such a large PE ratio. Cash flows are low, 2.3, on average 2.71, in line with what we see in the net margins. That's no surprise there. Dividend is super low, 0.84. Historic on average, 1.58. Definitely shows you that it's very overvalued right now. ROE looks really good, 18.48, but we got to look at the equity number, 1.93. They got a lot of debt. We honestly want to see that number essentially cut in half. And then pay off $78 billion worth of debt. ROI kind of low, 5.5. ROA also at 6%. Gross margins decent. I'd like to see those higher, but I don't think you're going to see anything really higher out of them. They try to keep low margins and high volume. If that's your thing, my only concern here would be the high debt. And that high debt is part of the process of stocking the shelves, making sure that there's product for people to buy. Expectations of high volume. So now we can go down and work on our thesis here and see what our average return might be. Clearly, around 4% is what they are getting for their revenue growth. Last 2 years, 4.2, analyst projection 4.4, and then 4.3 the following year. Share count, they look like they buy back around 1 to 2%. I mean, we can be more generous, give them 1.5%. But at these prices, they're not likely to do that. That's probably why it's down, is they're trading at a higher valuation. So 1% might even be too high based on the current share price. Cash flow growth, their cash flow yield holds pretty steady, so it'd be in line with revenues most likely, maybe a bit above to get back up to that average, but we'll just hold it in line. Assets, not much going on there. Same with liabilities. They have a massive balance sheet with both assets and liabilities, so it looks like both of them 1 to 2% in the last 2 years. We can say 1% for the assets, apparently 1.5 or so for the liabilities. It does tend to be. Last 2 years it was higher. I mean, technically it was lower in the last 3, so not super consistent on that. Dividend, they definitely are not crazy about. We get 1 to 2% out of them. And then margins, I would not expect much growth. In fact, I'm going to hold that flat. I think they're going to stay around 2.5. So with today's purchase price, this is an awful. This might be one of the worst stocks we've taken a look at. For that thesis, you're looking at about 2% annual growth in the fair value. Once you factor in that dividend, 2.8%, you're already buying it at a super high valuation. And so you're significantly underperforming the market in both the 3-year and the 5-year time frame. I was generous and I went and I tweaked the earnings multiple a little bit. So now with that thesis, you're looking at 5%, 5.6 once you factor in that dividend, and you're still underperforming the market very significantly. It's just at a very high price right now. I mean, even if you were to get in at the fair value with the low returns, you're not looking at anything pretty. I mean, you're not underwater at that point, but you're getting less than half of the market returns. Now, if you can get in at the margin of safety, then things are looking good. I mean, I think you could shrink this even a little bit. Let's see, does 20% get you there? It definitely does. In the 5-year, you're a bit over market returns. So you could go with a smaller margin of safety, maybe only 15% instead of 30. Bidding out the market in the 3-year, somewhat underperforming in the 5-year as long as it reaches its fair value. But that's not a price that we've seen. For these returns and these fundamentals, definitely not what I would be adding to my portfolio. I don't know what kind of portfolio would want this, to be honest. It's not growth. It's not dividend. I mean, we can go look at the price charts and see it's very consistent. It's definitely a blue chip stock. Balance sheet, very flat down here. Cash flow dipped down in 2021 and made its way back up until 2023, and it's flattened back out. The fair value dipped along with those cash flows. It's actually on somewhat of an uptrend. Dividend is almost completely flat. Earnings have just started to go up in 2023 and look like they've got some decent growth going forward. But the share price is just insane when compared to everything else. Now, there's a lot of people overpaying for it. In 2023, it was somewhat reasonable. I mean, still above the fair value. It looks like it's constantly above the fair value, aside from back in 2020, but we all know that everything was undervalued at that point. So that's not a huge surprise. If I held any, I would sell out because look at how far that share price has gone from all of the valuation metrics. It's just a very consistent company. I was going to say we can take a look at a worst case and a best case scenario. But best case is taking revenue up from 4 to 5%, and the share count 1.5%. But I already talked about why I don't think that's going to happen. Cash flows, let's say they outperform the revenues, 5.5%. Assets, we're already at the high. Liabilities, we'd want to go with the low here. So, and then dividend on the higher end, say 1.75. Margins, let's say there's actually some growth there. And what we're looking at there, in that case, 7%, 7.7 once you factor in the dividend. And let's see, could you buy at the fair value and be okay? It's closer to being in line with market returns. No, you're still underperforming by a bit. And that's our best case scenario there. So I don't know what people are seeing with this one. It might just be a part of the market bull cycle, and will be one that pulls back sharply once markets start to drop. So, I mean, I'd keep an eye on it as something to trade. I would short it. I would much rather short it than I would buy it. But that's what I'm looking at for this one. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.